Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thank you as always for joining me. Here we go again. The S&P 500 is flirting with new highs yet again. I mean, wow. I really feel sorry for the naysayers. It has got to be incredibly tough to be so wrong for so long. Now, I bring this up because the naysayers, the negative Nellies, whatever you want to call them, they've got one heck of a problem on their hands right now. Actually, two, because many have sat out yet another run higher off the April lows. Still others are worried about playing catch-up or simply getting back into stocks they've missed yet again despite the best intentions. We, on the other hand, have no such worries and no such illusions. Now, I've encouraged you repeatedly to hang on, to hang in, and to play offense every chance you get. Now, hopefully, you have done that, and you are doing that. Now, why would I say that? For one simple reason. Because innovation has never, ever failed to produce profits, and that, my friends, is an investable opportunity and a half. Sure, to be fair, the markets will go up and down, but the thing you want to keep top of mind, absolutely front and center, is that volatility is a traveling companion, not something to fear. Let's repeat that because it's really important. Volatility is a traveling companion, not something to fear. The question is how you handle it. Remember my maxim here, right? Pin it to your wall if you have to, write it on a post-it note, tape it to your refrigerator. Chaos creates opportunity, and the more of the former there is, the more of the latter you have. So here's my playbook today. Number 1, 3 reasons why I still urge caution, and 2 compelling companies to buy anyway. There are loads of people who think that the Middle East is a foregone conclusion. I'm not one of them. Been doing this a long time. I think it'd be premature. My good friend and colleague, the super savvy Scott, the cow guy Shelley, asked me about that on his show when we sat down to chat about it yesterday on RFD TV. Please watch that video. It's on my channel. I think it's going to be important and you'll find it valuable. Number 2, NATO defense spending to 5%. Now, we've talked about this before, and it looks like it's coming to fruition. NATO allies have agreed to raise defense spending to 5% of GDP by 2035, more than doubling the previous 2% target set in 2014. Now, the new framework calls for at least 3.5% towards core defense capabilities, with the rest supporting critical infrastructure innovation and industrial resilience. Member states must submit annual plans outlining their path to the goal. Now, the decision obviously reflects growing urgency around geopolitical threats, particularly Russia, and reinforces NATO's collective defense under Article 5. Secretary General Mark Rutte called it a quantum leap for alliance security and economic opportunity, and I agree, but I also call it investable. One of my favorite defense opportunity stocks has returned 65.36% since I brought it to the OBA family's attention, but the other's dragging, although I suspect for not much longer on this news. Now, the S&P 500, by comparison, has turned in 62.80%, so we're slightly ahead of the game, numerically speaking anyway. But the real win, and this is something that not a lot of people think about, and the one I'm counting on from a portfolio management perspective, is that the stock I'm alluding to is roughly 40% less volatile than the S&P 500, which means, when you think about it, that it's helping investors who own it achieve a higher risk-adjusted return than they otherwise would have, because the return on that stock is better than the S&P 500. Anyway, hoo-yah! Number 3, data centers are the new football stadiums. Now, Meta, in the news today, dropping $10 billion on what is being billed as the biggest data center in the Western Hemisphere, 2,250 acres of former soybean fields in Louisiana. Impressive, right? Not so fast. Meta's getting 20 years of tax breaks, courtesy of Louisiana officials who evidently skipped Econ 101. Now, there's only 500 permanent jobs, if I read the reports correctly, and if memory serves. Now, that's generous, considering how fast AI eats headcount. My guess is probably half of that. Anyway, meanwhile, the thing I want to think about, and what burns my jets here, is that the rest of the state is stuck with busted roads, underfunded schools, drugs, and higher taxes. Deals like this are not investment. They're corporate welfare with better PR. Think about it. If this project was really transformational as it's being built, Meta wouldn't hesitate to pay full freight. Instead, it is the exact same con we've seen for decades. Economic promises up front, fiscal hangover on the back end, swap stadium for server farm, and it's deja vu all over again. If a deal can't survive without tax breaks, then you know what? maybe it shouldn't. Keith's investing tip here. Think about this one for a second. Very few miners struck it rich during the gold rush, but plenty of folks selling shovels did. It's a very short list of stocks selling shovels. So, number 4, we've got a teaching moment on our hands. What do you do if you miss a trade or an investment opportunity? Well, you take a page from my own playbook. Yesterday, I suggested a counter trend trade using SPX or NASDAQ puts to capitalize on possibility of a quick downside reversal, but then I got sucked into meetings and all sorts of other things yesterday. So I wound up missing my own idea. Loads of aspiring investors and traders view a situation like this as the end of the world, and they get totally flummoxed by it. But it's not. Mindset is key. For one thing, the markets are always going to be here, and if they're not, there's a real problem. So missing a trade every now and then because life gets in the way is absolutely normal. It's not a reason to flip out. For another, things tend to happen for a reason. Both the S&P 500 and NASDAQ are up this morning as I record this, which means that any trade I might have placed would already be going against me, which is also not a big deal because that happens as part of the journey. If you want any kind of longevity in the markets and investing success whatsoever, you got to learn to step back and get comfortable with stepping forward every time you have to do it again. Speaking of which, I still think that the big money traders are itching to engineer a sharp, quick downdraft to get on board with many of the names that they've missed since April and to reset risk as the Middle East continues to jar headlines. So I'll be taking a fresh look at placing both trades today, and if the numbers line up, make my move. I encourage you to revisit that idea every time you feel like you've missed something, because the markets are going to be there, and they'll be there today, they'll be there tomorrow, they'll be there next week. So go on vacation. Spend time with your spouse, your wife, your significant other, your family, your sons, whatever it is you're doing, right? Because that's how the game's played. Many aspiring investors and traders worry about being right. But the thing you want to think about is the world's most successful investors and traders focus on being profitable, even if they're dead wrong, or in this case, miss an opportunity like I did. Let that sink in. Number 5, slapping two struggling brands together doesn't guarantee profits. Investors who fall for this kind of stuff tend to be worse off for the experience. Case in point, Krispy Kreme donuts will disappear from McDonald's menus starting next week because, get this, the partnership fell short of financial expectations. Shares of Krispy Kreme are down nearly 80% since the pilot scheme began, while shares of Uncle Ronald have increased 27.19% over the same time frame. Now, to put both of those figures in context, the S&P 500 by comparison has returned 70.51% since the pilot program rolled out. Junk food in all its guises has a way of doing that. Don't get me wrong. I'm the first to admit, I love my donuts, and I used to love my Big Macs before the last one I ate made me so sick an hour later that I have lost the desire ever to eat one again. But I digress. This is a textbook case of why scale without synergy doesn't work. Not in the markets, not in your life, not in your wallet, not in your stomach, and certainly not with your investments. What you want to focus on instead is something that we talk about frequently. Businesses that have 3 things in common: strong core demand, operational leverage, and pricing power. Not those relying on fancy brand name partnerships to paper over structural issues and problems. Think Apple versus Peloton, for example. I'll be here if you need me. Anyway, today's bottom line: when the bulls and bears fight, it's the chickens who often get slaughtered. So, stay sharp, don't be a chicken, and instead own the barnyard. As always, let's make it a great day. You got this, I promise, and I'll see you tomorrow. Thanks for watching.